Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at SoFi.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. We are looking at a company that has just undergone a dramatic transformation since 2018. It's critical for investors to understand not just the fact of that shift, but the monumental scale they've achieved.
It's hard to even connect the dots, right?
Yeah.
When you look at the numbers from 2018, it's a totally different company.
Totally different. They started with about, $250 million in revenue and a base of 650,000 members. It was a pretty small operation, relatively speaking.
And now?
Now the latest projections put their annual revenue over $3.5 billion, and their member base has just exploded past 12 million.
So this isn't just growth. I mean, this is a complete rewrite of the business in a really short time.
It is. Scaling like that, from a niche lender to this financial titan in 7 years, it demands a massive internal overhaul. But what's really fascinating is that the growth isn't siloed, it's systemic.
Meaning the members are actually using more of the platform, not just signing up.
Exactly. If you track product usage, the numbers are staggering. They're now managing over 18 million products for those 12 million members.
Which proves that the cross-selling strategy is really landing.
Exceptionally well. Product growth is clocking in at 36% year over year, which perfectly complements the 35% growth in their membership base. It tells you they're not just acquiring new users, they're monetizing the ones they have more effectively.
Okay, but the big question that always follows these high-growth, high-tech stories is sustainability. Can they actually make money while growing this fast?
And that's where the story gets really compelling. They have decisively crossed that threshold from a growth-at-all-costs company to one focused on disciplined, sustainable profitability.
So we're seeing positive net income.
For 8 consecutive quarters, this isn't a temporary trend anymore. It's a foundational change in how they operate.
And the margins are reflecting that, I assume.
They are. The net profit margin hit 13.5% in Q2 of 2025, and their operating margins aren't just positive, they're rising steadily. We saw that momentum in Q3 2025, where revenue topped expectations at nearly $950 million. That's a jump of almost 38% year over year.
To put that in context for our listeners, let's talk about that key benchmark for tech companies, the Rule of 40. Could you walk us through how they stack up?
Sure. The Rule of 40 is a simple but really powerful metric. It just says that a healthy tech company's revenue growth rate plus its EBITDA margin should be at or above 40%. It's a measure of that balance between growth and profit.
And SoFi?
They are absolutely crushing it. For the last 16 quarters straight, that's 4 full years, they've consistently exceeded the Rule of 40, averaging an incredible 58%.
Wow. To maintain that discipline while scaling so radically is...
Oh, it's extremely rare. It is. It shows management is prioritizing efficient, high-quality growth, not just top-line numbers. And that strength is reflected right on the balance sheet. They have ample liquidity, responsible leverage. It gives them a lot of flexibility for the future.
Okay, let's unpack the strategic core here, which is that diversification engine. For so long, SoFi was just synonymous with student loans. That's clearly not the case anymore.
It's the key takeaway, really.
Yeah.
In 2018, lending was 100% of their revenue. Today, lending is down to about 45% of the total.
Just think about that pivot. They've built up non-lending segments so fast that they're now over half the business.
And those segments are growing 57% year over year. This move toward fee-based recurring revenue is strategic genius. It fundamentally stabilizes their margins.
Making them less vulnerable to interest rate swings that can just batter traditional lenders.
Precisely. And that stability is powered by what they call the financial services productivity loop. That's a bit of a dense phrase, but the concept is simple.
The more you use, the more you stay.
That's it. Borrowing, saving, spending, investing. The more you tie into their ecosystem, the stickier you become, and the more likely you are to buy the next product.
And the data actually backs that up.
It does. A full 40% of all new products are opened by existing members. That is the clearest evidence of successful cross-selling and high retention. They're building a unified financial life for their customers.
Speaking of that unified structure, this brings us to the technology. Let's talk about Galileo because there's
Yep.
been some huge news there.
The integration with Amazon Web Services is a game changer. In October 2025, Galileo officially joined the AWS Partner Network
Why is that such a tectonic shift?
because it means any fintech or bank that's already using AWS infrastructure can instantly embed Galileo's tools.
So no costly, months-long platform migrations.
None. They can just switch on Galileo's capabilities, card issuance, transaction processing, fraud management right within their existing environment. It dramatically expands their addressable market.
Is meeting the customers where they are.
Exactly. They connect directly to AWS's global ecosystem of over 130,000 partners. It's a brilliant strategic move.
And beyond that infrastructure piece, we need to talk about artificial intelligence. They seem to be deploying it pretty aggressively.
They really are. They're running over 40 distinct AI proof of concepts, and they break it down into two categories, defensive and offensive.
Let's start with defensive. I'm guessing that's risk and cost.
Right. Defensive AI is used to automate and speed up remediation for things like account takeovers or disputes. It resolves issues faster and drastically lowers their operational costs.
And offensive AI is where they drive the growth.
Exactly. It's all about enhancing the customer experience through personalization, but crucially, they also use it to optimize marketing. It helps them find the right customer at the right time.
Which drives down customer acquisition costs and helps them maintain that incredible Rule of 40 performance we mentioned.
It's all connected.
Now, let's shift back to the core lending business. Because while it's proportionally smaller, it's still huge. Given the macro concerns, how healthy is their core borrower?
They have maintained incredibly rigorous underwriting standards. That's the key. They target a very selective consumer.
What does that look like?
The average borrower has a FICO score of 750 or higher and an average income well over $100,000. This demographic is just inherently more resilient.
So they're not seeing the credit deterioration that other lenders might be.
Management has said consistently they have not seen any, even as they ramp up origination volumes to around $9 billion last quarter. They are growing volume without sacrificing quality.
That's impressive. Now, looking at external catalysts, what happens if the Fed starts cutting interest rates?
A declining rate environment is arguably the single biggest external catalyst for them. Rate cuts would immediately boost demand for student loan refinancing and personal loans.
It's interesting, though. I saw that home loans are now expected to generate more revenue than student loan refinancing in Q4.
It's a remarkable shift, isn't it? Considering student loans were the entire foundation of the company.
But looking forward, there's another huge opportunity in the student loan world, right?
That's the potential end of government funding for Grad Plus loans. If that happens, it opens up a significant private lending opportunity. These loans are really attractive. They have 30% to 40% higher interest rates, but still perform very well on the credit side.
And what about the loan platform business? The LPB. This is where they originate loans for other companies, correct?
Yes. And the surprising part is the sheer scale of the opportunity they currently turn away. Management notes they decline about 70% of personal loan applicants.
Because they don't meet that high FICO target.
Exactly. That pool of near-prime loans they decline represents an estimated $100 billion market. They can't hold that risk themselves, but they can monetize it by originating and selling those loans to partners. It's a huge untapped source of fee revenue.
Okay, moving to the newest frontier. Digital assets. They're leaning in heavily with SoFi Crypto and SoFi Pay. What makes their approach different?
The structural advantage is that national bank charter. For SoFi Crypto, it's all about safety and soundness. Your funds sit in your interest-bearing SoFi Money account until the moment of execution.
So you don't have to move money to a separate non-bank digital wallet, which is where a lot of the risk and friction is.
Precisely. That convenience is a serious moat, and they're leaning even harder into that with the planned stablecoin.
This is the SoFi USD stablecoin set for January. How is this different from others that have run into trouble?
The key is the reserve mechanism. The reserves won't be held in a commercial bank. They'll be held in a Federal Reserve Bank account.
Which means what exactly?
It means zero credit, liquidity, or duration risk for the dollar backing the coin. It is the absolute gold standard for stability, and that is a massive selling point when you're marketing this to regional banks and large consumer companies.
And this all feeds into their new SoFi Pay platform.
Right. The goal is to compete with everything: ACH, Zelle, debit, wire. The initial launch is for international remittances, starting with Mexico, using the Lightning Network for super fast, cheap transactions.
So they're weaving this new digital infrastructure directly into their existing bank platform.
Yes. But structural moats aside, we have to address the technical picture, which has been screaming bullish. The stock is up over 105% year to date and 159% over the past year.
That's a phenomenal run. What are the indicators showing?
The price has consistently traded above its 50-day and 200-day moving averages all through 2025. I mean, that's the textbook definition of a sustained bullish trend. Momentum indicators like the MACD are firmly positive, showing sustained accumulation.
But as we always say, high returns come with high risk. We have to look at the downside. What do investors need to be monitoring here?
First thing is volatility. The stock's beta is high, about 1.94. So if the S&P 500 moves 1%, the stock tends to move almost 2%. That leverage cuts both ways.
And then there's just the execution risk of managing such a complex model.
There is. You're a bank, a lender, a tech provider, a digital asset processor. Managing the regulatory compliance and operational efficiency across all that is a massive challenge.
What about insider activity? We've seen huge institutional inflows, but what are the execs doing?
That's a critical point. Despite all the institutional confidence, there has been some notable insider selling recently, over 175,000 shares in the last 90 days. Investors need to watch that alongside the institutional buying.
So looking ahead, what are the near-term milestones?
The immediate focus is Q4 2025 earnings due January 30th. Expectations are high, especially for those non-lending segments. A miss there would be felt keenly.
And of course, January brings the planned launch of the SoFi USD stablecoin.
That will be the first big test of how they market that zero-risk advantage. And finally, you have to watch for M&A activity in the broader fintech space. Any consolidation could really cement their position.
You know, what stands out when you combine all these factors is the synergy. They've built the foundational profitability of a bank, but with the agility and tech of a disruptive fintech.
Exactly. That combination, leveraging their bank charter to mitigate risk while using AI and Galileo to rapidly scale, provides a truly unique structural advantage. They've successfully transitioned from a one-trick pony to a diversified financial utility.
So the key question you have to ask yourself, looking past the immediate volatility, is, does that structural advantage justify the current growth premium? And can they successfully execute on this really complex roadmap they've laid out for 2026? Remember to subscribe to Smart Wealth with Joshua for daily market insights.